Hello viewers. In this session, we will discuss how to measure performance of your rooms business. And we will do that in two steps. In step one, we will primarily be looking at how to measure internal performance using some metrics such as occupancy, ADR, and RevPAR. And in step two, we will try and put the hotel into a competitive set and see how you can measure competitive performance, that is your performance against the competition, by using indexes such as MPI, RGI, and ARI. So let's get started. We will start with occupancy. Occupancy is measured by the number of rooms sold for a particular period divided by the number of rooms available in a hotel for a particular period. This is normally derived as a percentage and it can be taken for a day, a month, a quarter, or a year, or any other period that you may want to measure. Simply put, the formula is rooms sold divided by available rooms into 100 to make it into a percentage. Now let's take an example of a hotel A. It has got 100 rooms available. On the 2nd of January, it sold 62 rooms. Therefore, the occupancy is 62 divided by 100 multiplied by 100, which becomes 62%. Now, the higher the occupancy is what everybody should be thriving for. And ideally, without any market benchmarks, an 80% and above occupancy is considered relatively good. Now, let's look at the second matrix. We are talking about average room rate or average daily rate, abbreviated as ARR or ADR. So we're going to use ADR in our future conversations. The formula of calculating in ADR is the total room revenue for a particular period divided by the number of rooms sold for the same period. Now let's take the example of the same hotel A. It had 100 rooms and it has 5 different categories of rooms. So there are 50 standard, 20 deluxe, 20 club, 8 suites and 2 deluxe suites. Now on Monday 2nd of January, these were the number of rooms sold. 35 standard rooms got sold, 12 deluxe rooms got sold, 11 club rooms, 3 suites, and 1 deluxe suite got sold, totaling 62 rooms. Now, the revenue that got generated from sale of each of these room categories is also listed on the right hand side. Total revenue that got generated by selling all the room types were 5,80,500 rupees. Now, the average rate formula, total room revenue, which is 5,80,500 divided by number of rooms sold, which is 62, makes the average rate as is 9,363 rupees. Now, you can also calculate the average rate of each of these room categories sold because you have the total number of rooms that were sold in every category and the revenue that got generated in that category. Please understand that sometimes rooms of the same category also gets sold at different price points in a certain market segment. And if you need to know more about this, you can always refer to the market segmentation lesson that I have done in another YouTube video. What is this signified is that you can also gauge the price positioning of your hotel in the competitive set, which means that the more the ADR indicates that you are a more premium hotel. Now we're going to discuss about another matrix, and this is a very important one. It's RevPAR. The highlighted letters primarily bring out the abbreviation, revenue per available room. Now, what's the fun of having a very high ADR but a low occupancy and vice versa? This metric primarily provides a singular dimension to the combined efficiency of price and occupancy, and therefore it is the most acceptable matrix to measure relative performance of price and occupancy. Therefore, the total room revenue divided by the total number of rooms available brings out the RevPAR. In the example that we were discussing, 5,80,500 was the total revenue generated on the 2nd of Jan, and 100 available rooms makes the RevPAR as 5,805 rupees. Now, this also can be calculated in a slightly different way too. So I'm putting the chart again, which has the number of rooms available per category, number of sold rooms per category, the revenue generated per category, and the average rate per category. If you plan the occupancy of each and every category that was sold, which is primarily the rooms sold by available rooms, 35, for example, 35 by 50, that's 70% occupancy and so on and so forth. The RevPAR also is calculated by multiplying average rate and occupancy percentage. So 7,500 into 70% also gives you 5250, which is the RevPAR of the standard room of the hotel. And overall, the hotel's RevPAR is 5,805 rupees, as we saw earlier. Now, the question is, what does this table mean to you? Please think about it and mention in the comments, but we will discuss a little more about this when we go to the competitive metrics and understand how we are performing against the competition. Now we move to step 2, and here we're going to understand how to measure your performance against your competitive set. In order to do that, I've created a competitive set which has Hotel A, B, and C. Hotel A has 100 rooms, Hotel B has 112 rooms, and Hotel C has 80 rooms. And these 3 hotels are all located in the same area. They also have a similar kind of a price point and they're catered to a similar kind of a customer set. In order to measure the competitive performance, we also must create a total comp set. Total number of rooms in the comp set is 100 plus 112 plus 80 is 292. On that particular day, 2nd of Jan, Monday, 208 rooms got sold. Total revenue that was generated was 18 lakhs 49,080. And by using the matrices that we've learned earlier, which is occupancy, percentage, ADR, and RevPAR, we've also calculated the comp set occupancy, ADR, and RevPAR. Now, the matrix that we're going to talk about is called MPI, or Market Penetration Index. Market Penetration Index gives a very clear understanding of what is our market share, which means that if the market has sold 208 rooms for a particular night, what was our share in that? In order to do that, we divide our occupancy by the comp set occupancy. On 2nd of Jan, Monday, our occupancy was 62% and the comp set occupancy was 71%. Hotel B's occupancy was 73% and Hotel C's occupancy was 80%. So by using this formula, we have calculated the MPI as follows. MPI is normally written in decimal, so we convert that percentage into decimal, and therefore Hotel A's MPI is 0.87, Hotel B's MPI is 1.03, and Hotel C's MPI is 1.12. The ideal MPI should always be greater than 1. When the MPI is greater than 1, it clearly means that your market share is appropriate. Anything lesser than that means that you're selling less number of rooms as compared to what the market is ideally selling. And MPI can also be ranked. Now we move to another matrix, that's ARI, or Average Rate Index. How is your pricing in the market as compared to your comp set hotels? Now, ARI is derived by dividing your ADR by the comp set ADR. And therefore, the ARI of Hotel A is 1.05, Hotel B is 1, and Hotel C is 0.94. Again, the ideal or a midway is 1, and therefore anybody who's below 1 is pricing lesser than what the market is pricing at, and anybody who's more than 1 is optimum priced for the market. Here you see that Hotel A has rank 1, Hotel B has rank 2, and Hotel C has rank 3. And while in the previous slide you saw that from an MPI perspective, Hotel A was rank 3 and was below 1, in this case, in the ARI perspective, Hotel A is rank 1 and has the best ARI. But what does it mean? Let's look at the next matrix and understand this a little better. Now we're going to talk about the most important matrix, which is the Revenue Generation Index, or RGI. This is holistic because it measures your RevPAR performance divided by the comp set RevPAR performance. And we already understood the importance of RevPAR when we are looking at internal performances. In this case, the RGI of Hotel A is 0.92, Hotel B is 1.03, and Hotel C is 1.06. And the ideal RGI being 1, Hotel A is definitely not meeting their RGI levels. Rank-wise, Hotel A is rank 3, Hotel B is rank 2, and Hotel C is rank 1. Let's put all the matrix together of what we have learned so far from a competitive performance point of view. We saw MPI, we saw ARI, and we saw RGI. If you see, Hotel C has the highest occupancy, Hotel A has the highest ADR, and Hotel C has the highest RevPAR. Rank-wise, you saw that Hotel A is ranked 3 in both MPI and RGI. Hotel B continues the same rank in ARI and MPI and RGI, and Hotel C has rank 1 in MPI and rank 1 in RGI, but it is rank 3 in ARI. What's the fun in having a high ADR but low occupancy, or low ADR with high occupancy? And if you have similar hotels in the comp set. So you need to pause and focus on the index and the ranks coming out. How each index is complementary to the other. See where are the opportunities and how by focusing on one parameter, RGI can improve. Hotel A has to clearly focus on bringing up the occupancy to be able to improve RGI. Their ARI is fine. Hotel B is just at the right levels in all the parameters. So it is important for them to be able to maintain the same. Although Hotel C has the best RGI, they must be leaving some money on the table, and therefore they could focus a bit on improving their ADR. And by doing so, their RGI may also be better. RGI matrix has given us a singular dimension to the combined efficiency of price and occupancy in the competitive set. If the index is above 1, it means the hotel is performing at the desired RevPAR levels, and therefore the occupancy and the ADR mix is justified. I hope you've been able to make some sense of these 3 indexes because they are very, very important for you to understand how your hotel is faring against the comp set. Please also relate this to your business and let me know what does this mean to you in the comment section. In our next part, we will try to understand how to measure success of restaurants and banquets. Thank you very much for watching.